welcome everybody, and thank you for joining us today on this month's virtual boardroom, which is the shape of the M&A market. I'm pleased to welcome Darren, Hodson and David Crump from PKF Smith Cooper Corporate Finance, and between them got many years' experience in corporate finance and have advised hundreds of businesses over the years on company sales and across a wide range of sectors. And yeah, we're looking forward to hearing their views on the current M&A landscape. What we'll do after their presentation, we'll take questions. So if you have questions, put them in the chat box and then we'll run through them at the end. But I'll hand over now for the presentation, and then I'll speak to you all shortly after for the questions at the end. Over to you, Darren.
Okay, thanks, Ben. I appreciate it's middle of August and people are either been on holiday or going on holiday, so this is a fairly light subject matter. Hopefully people will find it interesting. It's not one we often do as a webinar. We normally do something very much more specific, but actually we just thought it'd be quite interesting just to give people a flavour of the state of the UK M&A market in 2026. We'll give our views on what we think is going to happen towards the end of the year. We've got hot sectors and things like that. So, but we'll also try and make it as relevant to the people that are on the call as possible. For myself, I'm Corporate Finance Partner. I head Corporate Finance for PKF Smith Cooper. I'm ex-Big Four, disposal specialist, but work all parts of the market, done multiple sectors. So fundamentally sector agnostic, got a few specialisms, and been working in the industry for a number of years that I can't remember, but let's just say over 25 to 30.
And by way of introduction, I'm David Crump, Corporate Finance Director, and I've been with Smith Cooper for about 21 years now. As Darren said, sector agnostic, working in sort of all parts of the M&A market, but primarily sort of SME, OMBs, mid-corporates, and sector agnostic, really.
Yep. If you click on... And then this is kind of like some mini sales pitch on PKF. So it's more about credentials and ability to speak on this topic as well. But we're a global firm, probably 14th, 15th largest accountancy practice in the world. For our corporate finance capabilities, we probably do in volume terms around 200 deals a year. So I think last year we did about 6 billion in value. And that gives us quite a good insight of activity. Clearly, we're not whole of market, and we're very much focused on mid-market. So, and that's kind of deals in 1 to 50 million space. You can see our average there at the bottom right is 34 million. That's skewed by one large deal. It's probably a little bit lower in reality, our average deal size, but you get a kind of feel for us. So, you know, we are an active, one of the most active CF advisory firms in the UK. The agenda for today, loosely covered earlier, but market overview. So we're going to talk through some of the trends around volumes and values, and you'll see that they've been moving in opposite directions. So we'll kind of talk a bit about that. We've got a bit of a view on hot sectors. So what's hot at the moment? Where are people investing? And we kind of link that. We try and link that to multiples as well. So we've got a bit on multiples by sector. If we then have time, we can get a little bit into debt markets because they do fuel a bit of the M&A market. So, and you as FDs predominantly, you'll probably be interested in around where the debt markets are. And then we've got a bit on why owners transact, and then our outlook and summary. And we try and leave plenty of time for Q&A as well. So the high-level message is values in so far this year are at a record pace, and volumes are lagging behind. So you can see on this slide, that 179 billion, that's a kind of year-to-date stat. And if that works all the way through to a full year, that would probably be about 350 billion on a pro rata basis, which would make it the highest value year we've ever known. I think the previous one was 2015, according to these notes. But you'll see kind of the next shocking stats next to it is in that Q1 results, volumes were down quite significantly, so 30% down. So values up, volumes down. So what does that really mean in what's going on in the M&A market? It's basically there's been a return of big deals. So some of the mega deals are influencing the M&A market, whilst I would say the mainstay kind of mid-market transactions have fallen away a bit. And I think David, had a bit of experience around that kind of last year, which was to December. I think we were incredibly busy and having a great year. We had lots of deals carrying through into Q1, so we remained busy. But at the same time, I was speaking to competitors, and they were saying they haven't got anything on, and that they felt like it was a really polarized market.
Yes, yeah. I think, whilst that volume is probably down, and we'll talk about this shortly, the expectation is that that's going to start to come back as well. And perhaps not to the same volume, but certainly we're expecting an uptick in activity.
Yeah, I think I felt at the time at the last budget, which was the November budget, I seem to remember, our active deal pipeline was very strong, but the pitch list had become really thin. So the number of new opportunities coming through remained thin. And it wasn't until it felt like the Iraq war, the Iran war that Donald Trump created around February, March, that the market remained quiet on new prospects over that period, which then has a knock-on impact. But it seemed to change as we get more into 2026. I think the next really big kind of stat on this is 86% of deals year to date have gone to overseas buyers. That's probably, I haven't kind of gone through I'm not a historian and gone through all the records, but actually that's quite a high proportion. And
it's probably worth saying, Darren, that's by deal value as well, rather than deal volume.
Yeah.
And that sort of, I suppose, links to the point you made earlier about the significance of some of the mega deals that have happened during that year.
Yeah. And then we've put financial services, the next block on this, which is that's probably the hottest sector this year. Again, we'll talk about this in a bit more detail, but financial services has kind of been the standouts, alongside a few other sectors that have been interesting. And the next box of 45%, this is kind of, if you're a quoted company and selling, i.e. someone's doing a takeover, the premium sitting at 45%. That's quite high, and it probably links to this overseas buyers point, which is London's stock market is deemed low value. Everybody's heard about people offshoring now to the US or elsewhere. So people coming in with large bids for the UK PLC, but I think that equally applies to the SME world as well. So although there's probably a flight to quality, I think, going on in 2026 around different businesses.
And I think just picking up on an earlier point, really, the SME market, OMB and mid corporates, I suppose, is in that sub 10 million transaction range, is where the bulk of the volume of the transactions is still being seen. So whilst the big number statistics are probably in the mega deal zones, it's the SME market which is driving the volume of activity.
Yeah.
Flick on.
Yeah.
So I guess what this is really just demonstrating is a little bit what Darren's just talked about, sort of the gradual decline in the blue bars, which are volume of deals. And you can see there are a few sort of points in the quarterly cycles where there are drivers for deal activity. So take the October 24 budget, which changed capital gains taxes. That saw a bit of a drive of activity in Q4 of 24, and then in probably the very, very early part of Q2 of 25. So just before the change in the tax, uh, well, particularly BADR in April of 2025. You can see Q1 is pretty low in terms of volume, but as I said earlier, we're expecting that to sort of pick up a little bit in the next quarter. And the orange bars beneath that really do demonstrate the impact of these mega deals on value of transactions which are completed in each quarter. And you can see there, particularly Q1 25 and Q4 25, some big deals that have skewed the numbers compared with the volumes that we're seeing.
Yeah. Should we go to the next? And then this just exemplifies what we've just said, really, that on that first slide with, well, actually, 25 was down 30%, and then we're down again 30%. But if you kind of look at the monthly trends, it kind of feels okay. I mean, kind of as an advisor sat in the market, we haven't seen anywhere near that level of decline, I wouldn't say. So it still feels active. As I kind of alluded to before, I think in March this year we saw an uptick in new inquiry rates with vendors looking to sell. So I'd say we're predominantly a sell side house, although we do everything. And I think when that conversations with competitors, it kind of felt like April, May, the competitors started getting busy. So I think the volumes being down is starting to reverse, and I wouldn't be surprised if volumes by the end of the year kind of counterbalance some of the negativity in that first quarter. Um, it's really difficult to define what has happened, why volumes are down. I mean, there's been a lot of uncertainty in the market, and I think M&A doesn't like that uncertainty. So both myself, well, me and David, we've seen deals fall over just because of change of Labour leadership. And what does that mean for strategy and therefore pulling out of deals? And that kind of uncertainty can just make people want to pause. And every time we seem to get momentum in the UK, it seems to be taken away somewhere else. So it's quite a frustrated market. So we're probably bumping around at the bottom ish. We're kind of it's doing all right.
It's probably worth picking up on that middle point really, and why that volume has fallen. And it really is down to confidence. So diligence is much more deep and onerous than it's ever been, and along sort of particularly in the sort of split chain exchange and completion, there's a bigger gap between those two triggers. We're seeing people that there will always be reasons, and we'll talk to a little bit later on this as to why people are still looking for an exit. There'll always be those drivers, but for some people, they're sitting on their hands at the moment and just choosing to wait for various factors. But as I said, will always be people that want and need to transact.
Yeah.
So I guess by value, and that's what this graph shows, a lot of the inward investment, sorry, a lot of the deal activity is from inward investment, and you can see there some big numbers, primarily, I think, caused by some of the mega deals that we talked earlier of, and clearly that skews the numbers. You said earlier, whilst the numbers are smaller for the domestic market, UK to UK, the volume is where that sits. So the smaller deals, the OMBs, the SMEs, mid corporates, are in that sort of smaller band there, and that's accounting for the large part of the volume, but not the value. I suppose Darren alluded earlier as well to the domestic market sort of being attractive to overseas buyers for various reasons, and we are seeing that inward sort of activity as demonstrated really with the mega deals.
Yeah, and I think for us where we sit, we do most. We're probably not doing well. We're not doing the mega deals, the multi-billion stuff. So we're the sub 250. I'd probably say, David, half of our deals are UK to UK. Again, we haven't seen a dramatic turn off of UK appetite for assets, but I do think this all links back to the same point about confidence. I can kind of see if you're in the US or international, the UK is a relatively stable base. So, steady government, steady interest rates, things like that. So fairly sheltered from some things that are going on in the world. But if you're sat in the UK, you're probably you've got a lot of media, you've got the cost of living, you've got kind of a consumer confidence crisis almost, and you live and breathe that. And I think that's kind of almost polarizing the UK market on a standalone basis versus how international perceptions might see us, which I think is quite an interesting dynamic. And this kind of goes on to really summarize that the big market stuff. So on the left, there's some headline deals. You can see 44 billion, 15, 10, 9, 9. And basically, those deals account for 52% of M&A value in the UK in 2026. That is a staggering percentage. There's still a few more of those to come through. But most of the people on this call will be in the right hand box, perhaps sub 50 million deal value as an example. And actually, kind of fundamentally, whilst volumes are down, you'd naturally think that values would be down, but actually values are pretty much holding. And we've not seen any degradation in value, which I think is quite interesting. I don't know if you got any comments on that.
Yeah, they do it. I suppose we'll get into detail on the specific sectors in a minute, but that generalization of sort of 6 times for deals in that sort of, I suppose, above a million of EBITDA range is pretty consistent with what it was for the entire of last year, which was 6.2. So it's obviously skewed by it's driven by averages, so that's nice to see actually that the market is holding.
Yeah. There's probably not much more to say there, is there?
I guess the bottom right hand side, the part there really is what buyers are looking for continues to be sort of nice, scalable, clean business assets, and they will, always attract the interest. But those with less of those attributes tend to get less interested parties looking at them. Statement of the obvious, really.
Yeah. So you can kind of see on this slide, market is dominated by some big deals. And this kind of just graphically represents what we're just saying about multiples, that kind of small cap, the sub 250 million, broadly 6 times. Now, you've got to take this as a trend rather than this is what every business is worth. So every business has a different dynamic. So this is averaging on averaging, but you can kind of see the market's held. I think our experience would probably say there has been a flight to quality. So the better businesses are probably getting better multiples, and the lower quality businesses probably getting slightly lower multiples. And so it's kind of averaging out. I think that's probably where we see the market, which is kind of quite interesting. But clearly, that if you compare that to what we said about public markets, where the PLCs are getting on average a 45% uplift on share price, we're not really seeing that dynamic in the mid market.
And you can see there that the sort of the smaller, much smaller deals, those below 2.5 million of enterprise value are transacting for a lower multiple. And that kind of points, I suppose, to the quality matter that Darren was talked about there, and scalability and things like that does have a bearing on multiple.
David, do you want to cover this?
Yeah, so I think you talked about the 45% premium of those in the public market. So this is for 22 deals that have been disclosed, and where the price for the takeover was 45% more than the listed trading price. So value is up there 33% on 2025. And then back to that mega deals point that I suppose that we talked quite a few times about earlier on. Transaction value is 39 billion, and that goes to the skewing of the value trends that we talked about. What's interesting is that of the overseas related transactions and the acquirers, over half of them are coming from the US. So back to Darren's point, really, I suppose, about the view of the UK market. But we're also seeing quite a lot of inward investment from Sweden, Ireland, Germany, and some of the other Nordic countries as well.
I mean, it's quite interesting, isn't it? The Swedish model, I'm kind of a bit envious of versus, say, where the UK is. So in Sweden, there's a number of conglomerates set up, and the conglomerates go on a buy and build strategy. So they might acquire 50 to 100 businesses and get themselves to a multi-billion-pound position, but by owning lots of SME businesses, and getting the capital for it. And they probably started entering the UK about 10 years ago, but then they're much more prolific now in the UK, looking for investments and opportunities. And to me, it's a shame that there's not many in the UK that adopt that philosophy, and try and do the same conglomerate build-up. It'd be great to see. Maybe I should just go and do it myself. But yeah, I mean, that's why Sweden's kind of driving it, because they've looked at the UK and gone, actually, it's close to home, it's a good market, let's do the same as what we've already done in Sweden. I think the other bit just on there is who's competing. We come on to talk about this a bit more, but the PE activity was down in that Q1. So if you kind of think of some of the stats that we've presented, which was UK to UK volumes are down, I think PE volumes are down, and that could also indicate that that's why the overseas looks like it's significantly increased. So I think there's this just balance between the two of, why is UK sponsors not quite coming through on deals, and why aren't UK to UK doing those deals? And I think that comes back to the sentiment in the UK market and people feeling the uncertainty, where the US, where US and Europe have just said, let's just plow on because this is fundamentally a good market.
And I think I was with a private equity house yesterday, and they basically agreed with that sentiment really on last year, seeing lower volume, lower activity for the PE market, but they're seeing that this year they'll be back to their normal averages of activity and investment.
Yeah, I think kind of coming back to that point of we don't have look forward data to be able to present to you, but the anecdotal is the market's coming back, subject to probably the Andy Burnham impact. And we don't know how that will flow through. There's another budget coming forward, isn't there? And that will raise tensions, but that actually might drive deal activity to the end of October more fundamentally. So I suspect it will probably look like an all right year when you look at it overall, but with some of the mega deals in there.
Yeah. Sectors. So I don't suppose it will come as a surprise to many people. Financial services, tech, infrastructure are sort of top of our sort of hot list there, and particularly with the mega deals, where predominantly within the financial services sector, where a lot of activity was done, in particular wealth and asset management, virtually 23 billion sitting in that financial services sector, and that gives a big skew towards value in that sector. But it still remains attractive in the mid market as well, as does tech and infrastructure. And you're seeing an uptick in deals in those in particular.
Yeah, I mean, somebody, David, asked a question around where in financial services have we seen more deals, and it would be that wealth, asset, and management. I mean, there's a few other sectors, but fundamentally, it's the wealth management side has been the most active, and that is a market that's dominated by sponsor-backed businesses in the UK. So there's a lot of people chasing a buy and build around it, which is kind of driving that activity. It's also kind of again, I think the financial markets have been quite good over the last 2 years. So I think that people are kind of going, let's get some more of this because actually the returns have been quite good. Where on the technology side, software, as an example, has been under challenge. So software businesses, their valuations, whilst it's a hot sector and there's deals going on, their valuations have eroded probably over the last 12 months or 18 months, and that's partly on the back of the threat of AI, and kind of does it disrupt the recurring revenue model? But you can see here from a volume perspective, actually, tech IT is still quite strong.
Business services, professional services continues to be an area of interest, particularly, I suppose, to PE and the sector consolidators that are typically backed by PE as well. So whilst there's quite a lot of trade activity there, it is sort of PE backed ultimately. And I suppose no one would be too surprised either to see construction and house building sort of down the bottom end of that sector list there. So tends to
Well,
be limited really to distressed or strategic acquisitions that are being made.
yeah, I mean, I'm ex Deloitte, so when I was at Deloitte, we used to track the consumer confidence index that they produce, and I still look at it today. And this is kind of, I find this insane that since Lehman's went bust in 2008, that when the consumer confidence index went negative for the first time, it has never gone back to positive. It's just the consumer confidence has been at an all-time low for decades. Clearly, it's kind of improved. I say all-time low. It's improved, so it's not as negative as it was, but it's never flipped back into positive. And comes back to this point: if you're in the UK and you feel this, you just feel like that we never quite get to the point where we have any momentum. And construction and house building, you think this is the number one area for the government, so house building should be a hot sector, but it's just not happened. It's kind of almost the reverse has happened, and you've got some issues with businesses that face government sector on house building, like Vistry. So there's some real challenges on it, but if you kind of think of the business models for consumer and construction, it's much more low visibility of sales and sales growth and project based, kind of all house building linked to consumer spend, which people would feel there's not much of that around today. So no wonder they're cooling, I guess. There's a question on industrials. Ben, I can't quite see that. I don't know whether you want to just read that out whilst we're on this page. You're on mute.
Sorry. Yeah. So Julian's asked, where do industrials sit among these categories?
Well, I think same with industrials, it's just doing okay. So what we've done on this page is put what's hot,
What's not?
and what's not hot. So we haven't really covered the middle ground. So industrials, there's still kind of decent slug of activity basically going on, but it's not increasing substantially or not decreasing substantially.
I think I read a statistic that industrials, together with business and professional services, accounted for about half of transactions. So
Yeah,
it's
key
it's in
sector,
that.
isn't it?
Yeah, it's a key sector for the UK market without question.
But I wouldn't say it's particularly tracking hot or cold at the moment.
You move on.
Yeah.
So this is where we start to sort of break down what a typical multiple would look like in the various different sectors. Have we got industrials on there? Yes, probably in engineering and within that sector there. So multiples haven't really changed, I would guess, in that engineering sector. But what we're seeing, and this is very much a typical average, that you do see at either end of the spectrum, and I suppose beyond that as well. The multiples sort of go beyond what we see there, and the what we tend to find is that the sector kind of almost sets the multiple, but it's the business, the individual attributes of that business within the sector really that decides what the ultimate multiple is that you transact at. But in the statistic earlier we saw was about six times EBITDA is the average across all of those sectors for deals where the underlying EBITDA is above 1 million. What we tend to find, and the market evidence is supporting that, is probably 1.5 times or thereabouts multiple reduction for deal size where the underlying EBITDA is less than 1 million.
So actually, what does that mean for businesses? But some multiples can be cyclical, so it does change with time. But actually, if you're a small business, actually there might be more value for you in just getting over to that sustainable above 1 million. Just as an example, because the multiple turn does start to dramatically change as you get to that size. So maybe that's the priority rather than trying to wait for a cyclical high on a multiple.
I suppose that's just sort of demonstrating really that scale proves to be more attractive to the buyer population.
David, you didn't read out our slogan at the bottom of the page. The sector
Sorry.
the individual business decides where you land.
I primed you for that, Darren.
Okay. Yeah, I think that's probably the most important bit on this, that recurring revenues, contracted revenues, revenue visibility, time margins, where you sit is probably more important than sector, but sector has an impact because if a buyer's in a certain sector, they're used to a certain range of multiples.
Yeah. You made the point here in the middle bit about sort of the recurring contracted scalable nature of a business. Other sectors have that sort of beyond what we've listed there as the software, the SaaS, IT and whatever. And that those attributes help push the multiple in any sector really.
Yeah. It's probably worth saying on professional services, one of the reasons why we think that were set on fire in terms of deal activity a few years ago, we think it all links to COVID. So when Warren Buffett said you don't get to see who's swimming naked until the tide goes out, and basically, COVID was a bit like that. So the tide went out for a lot of businesses, and a lot of businesses struggled. But in that period, what became very clear was the resilience of professional services and accounting functions So the audit functions just had to carry on. There was no stopping the regulation. There were some tweaks to it, but fundamentally, the revenues carried on, and that showed a robustness that probably people hadn't caught on to prior to that, which then led to the spate of deal activity in that industry because everybody started to realize, there's quite a solid recurring revenue base here, rather than just thinking this is just an annual contract. I mean, someone's asked which sector gets higher multiple, law or accountancy. Well, I'm from accountancy, so I'm going to say accountancy. I don't, I don't think it's probably the right question. I think it's about business model and positioning, and are you a platform business? That's what I say. And do you get to scale, and what's your differentiation? So I think they're probably equally valued. What you tend to find with lawyers is they're probably not as well set up commercially as accountants. Because of that, you probably get stronger multiples for accountants than lawyers. But that doesn't mean applies to every law firm in the world.
You've also got the nature of the revenue stream, haven't you, been sort of more recurring with an accountancy practice than perhaps you would with a legal practice where it tends to be more transactional. So with you look at accountancy audit in particular, that's sort of year on year sort of recurring income really.
Yeah, and just to re-emphasize, don't take these bandings as that's all that's possible. We're trying to articulate what's typical. So, I've sold engineering businesses for 10 times. I've sold service businesses for 20 times. You can get higher multiples. It really does depend on the business and the competitive landscape.
Move on.
Yep.
So perhaps just rattle through the debt market.
Yeah, conscious of
the time. We've got a stat on here that I've just updated. There's been a change in the inflation today, 2.9%. The statistic there, 2.6% inflation, was around when the last MPC committee meeting was held, and the Bank of England base rate was held at 3.75, remained there since December 25. But I suppose that's fallen quite a long way from where it was a couple of years ago. 5.25 it maxed out at. So market's not looking at further sort of increases in the longer term. I think there's a general consensus of opinion that it's going to come down gradually, perhaps not as quick as we originally hoped and thought would be the case. Interesting statistic is that 70% of credit transactions come from non-high street bank lenders. So you've got debt funds, challenger banks, and that is increasingly sort of an area where, particularly in the areas that we operate, the OMB mid-corporate market, that we're seeing a lot more activity from those types of lenders rather than the high street. The high street will maintain they're still open for business, and I'm sure that is the case. But we are seeing a lot more activity from the challengers and those alternative providers of finance. And the big number in the right-hand corner there demonstrates the sort of the dry powder that we call it, that's sort of sat there waiting in private equity and equity investors, sort of accounts ready to be deployed. So there's still cash there to be deployed, but it's for the right asset.
I guess the feature of that debt, it can be more expensive debt, but structurally, people are much more inventive by being a non-bank and can be more supportive. So they're after partnership, relationship, and trying to listen to what you're after. But I'm still staggered that 70% of the market is non-bank. It's incredible, given probably pre-Lehman's that was dominated by probably the big four. David, we probably should flick through to the conclusion slides.
Saw someone ask earlier if we could share copies of the slides. Absolutely, yes, we can. And then any areas that we've just flashed past, if there's any questions, don't hesitate to reach out to Darren or myself.
Yeah. There was a question around tax, wasn't there, that I saw, I think, do we expect changes? And this is kind of links to our outlook. So we think, despite the stats, we think the mid-market M&A is all right. It's doing okay. We've got a new thing coming in, which is the budget, which is kind of our last point on this slide. And I think that's going to create uncertainty again because there's already been some press. I think it was in the Telegraph about Neil Kinnock saying we need to move capital gains tax to 40% to make it equal to income tax. And so it just looks like capital gains tax is going to be on the agenda. And it's no bad thing for government to want to worry people, because what we've seen, especially in the Sunak when he was chancellor, was that uncertainty actually drove drove fear, which drove activity. So they got more cash in because on the back of it. So I don't know whether that's happening, but I've spoken to a few people and some big wealth managers who are expecting a change in CGT, perhaps not an equalise, but a slight moving up. We now know the date, don't we? So we now know 26th of October, I think it is. But that's kind of one of the big things. And I wouldn't be surprised if there's a lot of deal activity for the ones that are active now to go and get done. But there's a lot more data, I think, coming through. I think we're kind of looking at part of a year, a bit rear view mirror. I suspect that the overseas will balance out with private equity, and we'll start to see a few of those stats. So PE being 33% of deals, and they're normally more like 40 to 50. I think that will come back because there's nothing stopping PE fundamentally. So there's a few things just to watch out for in the coming months on activity. So if we just skip to the next one. So we've talked about values at record pace, volumes not at the moment, but we think we'll be okay. Overseas buyers setting the pace, but we think the challenge will come back from UK sponsors. Financial services, the standout sector, that's predominantly wealth management, driven by some mega deals, but it's still activity, and there's a lot going on in the wealth management side. Debt is available. There's lots of alternative funders out there who are dominating the market, but clearly it still comes with some teeth. And quality of assets, fiercely contested, perhaps the rest are not. That's kind of our overall conclusion on state of the UK M&A market. Conscious we answered some questions in there as well, but do you have some more? I think we might have missed some.
I think there's a couple we may have missed on the way. I've answered a few of them, which is great. So thank you. So I mean, Jan's asked here, I mean, do you have any update on the VC scale-up market?
So the VC scale-up market, my understanding of it is it's been in decline kind of year on year for a few years. I think there's again different views around the UK. So when I speak to people wanting to scale up, they go, it's hard to get money, it's over-regulated in the UK. Should I go overseas? It's kind of, there's kind of real negativity around UK markets, but I would kind of counterbalance that and say the money is still there. You can still get it. There's people wanting to invest for good models, but there is this. It depends on what the scale up is. So the AI impact has probably slowed that as well, I think. So the challenge on business models is more acute now because of AI, and therefore maybe that's what slowed the market in the last few years rather than desire from sponsors or lack of cash.
Thank you. A question here from Paul: Is volume down on assets looking to exit, or PE buy and build strategies being down.
The stat was it was down on volume of sales. So I mean, both are down is the reality. So both sponsor and normal strategic is down. But as I said, that's that's the statistics, the historical statistics. I suspect we're now on a recovery and it's going upwards. I think we've kind of hit the bottom and going upwards now.
Good stuff. And I think everything else in there was probably answered throughout, actually. Yeah, we've picked up a couple on the way there, and some were asked, but then else in the slides anyway. So I think that's everything, really, unless anybody's got any final questions.
I mean, there's also, if anybody wanted us to do the other parts of the presentation, we could cover those off.
Or, and well, now you mean if we've got, yeah, we can do. If anybody wants to stay on and do that, or if there's a show of hands for that, we can. If not, we can get copies of the slides to everybody.
Yeah.
And the recording will be available as well in our members area.
Yeah.
But yeah, I think. So yeah, we've got a couple of so there's a couple of people willing to stay on. I mean, if you can't stay on, feel free to leave by all means, and we'll get you a copy of this if you want it. But yeah, if we can cover that as well, then great. Might as well we'll be here. Yeah, perfect.
I think this is probably where we got to on the debt piece. I suppose covenants wise, it's all about serviceability. So cash available for debt service, and that is the key metric really that any funder is looking at when measuring quantums of debt. So I think what we're probably seeing is that the banks and other funders are trying to get their money back as quickly as possible, and the debt service ratio sort of is geared towards looking at the achievability of that goal. So their covenants may be renegotiable, but I think it's down to setting them at sensible sort of hurdles at the outset, really, when you're sort of looking to raise that debt.
There's an adage with lenders, which is when it's sunny, they like to give you an umbrella, and when it's raining, they want it back.
Yeah.
Which probably sums up how banks works.
And I suppose this bit at the bottom is right up everyone's street who is on this call. Funders like to see good quality, clean MI that can be diligenced, that can be reconciled back, bridged back to statutory accounts, movements in the working capital cycle. So if there are any anomalies or anything that can be tightened up, that is the time, before you approach the debt market or funding market to do that and get the financials in a nice position that are clean for a funder.
I mean, it's interesting, David. I was just on the previous slide where we talked about interest rates and interest rates falling from whatever it was, 5 or 6%, and down to 3.75. We would have said that would have driven M&A activity, but it didn't, did it? As you can see, the stats, it's kind of stayed level and then maybe gone down a bit and recovering now. It's quite interesting that it didn't really influence the M&A market. We still like to see it come down to its long-term average of 3%. And I still think that would drive more activity, but clearly there's more things going on than just interest rates.
Yeah. So we'll move on from debt market. Why owners are transacting then? So this is, I suppose, internal, external push and pull factors at play here. So you're always going to have these internal factors. There are reasons why people will want to transact. So, lifestyle changes, age, health, retirement, desire to sort of pass on to the next generation, or it could be about sort of the business sort of needing to go through a period of growth, and whether people have got either the time, energy, or funding to do that is sometimes a driver for a transaction. And goal incongruence as well. We very often see that, with around the boardroom table, there are perhaps different ages, different horizons, different expectations and desires, and that again sort of drives a transaction. So I think probably talked there about all of the internal factors, but external factors, the tax change we talked about, the potential for CGT changes, and we saw in the data earlier that the proposed and implemented changes to CGT did have an impact on the volume of activity. But there's obviously wider macroeconomic factors at play as well, and the geopolitical situation in the Middle East has had a bearing on some of the transactions we're working on. We've got a business at the moment that operates both in the UK and in Middle East, and that's sort of been put on hold pending, really, I suppose, resolution of what's happening out in the Middle East.
I mean, we do see businesses can hold on too long, so chasing the extra pound, either on waiting for a different timing point in the M&A market, or their own business performance, or waiting for a particular cycle to hit. And I always think there's a danger of waiting too long. I mean, you've got to be lucky to time it perfectly, and some people do get lucky. But I'd say majority, it's really hard, it's difficult timing, and that hanging on too long can actually result in a far worse position, and you being in a more defense. What's the word I'm after? You being on the defense rather than on the front foot, because you just need to do it at that point. It's probably the biggest mistake we see of people. Okay.
Tax, we talked about that, I think, quite a bit of detail.
Yeah.
Any questions, please don't contact us because I'm not a tax expert, but we have got tax colleagues who I'm sure would be very happy to have a conversation. Neither Darren nor I sort of we know the basics, but not the detail. So we pick up the phone when we get tax questions.
We know enough to be dangerous, don't we, David?
So this is sort of, I suppose, exit options, and what this slide talks to really are the sort of day one cash that is achievable through the various different exit options, whether there's a participation in ongoing equity, and the level of complexity of a transaction. The bottom one there, IPO, I think is probably limited to some fairly scalable businesses and already at scale. The rest are probably options that are available to the wider market in the mid-market space.
Okay. I think we should leave it there. We covered the rest, didn't we?
Yeah.
Just to say a big thank you to guys at FT Recruits for allowing us this opportunity. And hopefully you'll find parts of the presentation useful.
All right, great stuff. Thanks, Dan. Thanks, David. Really appreciate it. I will email everybody. We'll get copies of the slides. We'll get those out to everybody, and then a copy of the recording will be available online as well. But thank you all for coming. Really appreciate it, and we'll see you again next month, I hope.
Thank you all.